Thank you, Mr. Aditya, for the introduction. Uh, as far as this topic which was assigned to us regarding this Companies Act and the time assigned to it is, of course, is very less. Uh, as you must have seen that there are less number of sections, all this are there in this particular act. However, the number of rules which the government has prescribed, so put together act plus rules has become the much more than what was there in 1956 act. Uh, of course, 1956 Act, I have an emotional relationship with that since that act was passed. So my grandfather was the committee of that particular act, which was presented in the parliament that time. Uh, now, this in my presentation, I will take some of the specific issues. May be impacting the broker community, may not be, but however, there are certain areas which I thought it must have already hit you, whether you have done or not. So let me begin with this. Now, as far as my presentation part is concerned, these are the specific topic which I'm going to take. Um, this is one-person company, which Mr. Atul Mehta has already said about it. Deposit, disqualification of directors. I have put this particular point intentionally. You may be thinking why this is hitting us, but I put it intentionally. Vacation of office of a director, resignation of director, then restriction on the powers of the board, loans to director, loans and investment by the company, a related party, and there are certain general topics. Now, before going to the detail, small disclaimer that whatever you want to do, please seek the professional advice before going ahead. Now, let me start with the one-person company. This is a new concept which is there in this Companies Act 2013. Section 2, clause defines the one-person company, means a company which has only one person as a member. So it's a new concept which the government has brought into. The companies, apart from this, as it was already said that the government has having the rules making power as far as regulation of this particular act is concerned, and in the broking community who belong to SEBI, as their prime regulator, they must have understand this thing is very well, where the SEBI has lot of rules making powers instead of all the provisions prescribed in the act. They have as many as 86 different regulations. So something like this act is also having presently 17 rules have already been notified. So this is one of the rules that the Companies Incorporation Rules 2014, which has came into force with effect from April 1st, 2014. Now, this says that only a natural person who is an Indian citizen, resident in India, is eligible to incorporate and to be nominated. Now, what is this nomination? I'll come into this. You have already heard this thing that whenever you want to incorporate a one-person company, there has to be one person who has been appointed by the member of the company, that one member of the company, as the nominee of that particular person. So in case of the death of the member death of the member of that one-person company, this nominee will become the member. So nomination of OPC is mandatory as far as this act is concerned, and nomination details is to be provided at the time of incorporation itself. Then the change, if any change is there in the nominee, it can be done by the member, or nominee can also withdraw his consent to act as a nominee. Then no person shall be eligible to incorporate more than one one-person company or become nominee in more than one such company. So this is one of the provisions that you cannot have more than one-person companies. Now, if any member, and this act is also talking about the nominee, you cannot have the nominee of more than one-person company. Now, suppose you are the member of a OPC and also the nominee of another OPC, and that the another OPC where you are the nominee, in case of the death of the member, then you have become the nominee of, you have become the member of two OPCs. So there is a transition period is given, that is 180 days. You have to decide about in which company you want to continue as a member, and you have to transfer the shares of another OPC. The no minor become the member or the nominee in OPC or he cannot hold any share, any beneficial interest in any of the security or any of the shares of that particular OPC. Then OPC cannot perform the Section 8 company or the NBFC objective. Section 8 is just similar to the Section 25 companies, which is the non-profit organization in 1956 Act. So similar, this Section 8 companies are there. Now, there are specific provisions given related to the conversion of OPC into public or private company. So there is a threshold limit is given. There are two type of conversion in the act. One is the compulsory. When on the happening of certain events, you have to compulsorily convert your OPC into either private company or a public company. Or second one is the voluntarily, when you yourself can go for the conversion. So if there is a threshold limit is prescribed, now if the paid up capital of that OPC is exceed rupees 50 lakhs, or the average annual turnover during the relevant period. Now what is this relevant period is defined subsequently, exceed rupees 2 crore. So then you have to compulsorily convert your one-person company into either a private company or a public company. Relevant period is defined that the preceding 3 consecutive financial year. So, and the transition period is given 6 months. So if at any point of time your turnover is crossing 2 crore or the paid up capital is going to increase beyond 50 lakhs. So within a period of 6 months, you have to compulsorily convert your OPC into either private or a public company. And the intimation of such conversion is required to be given to the ROC in a newly prescribed form INC 5. There is a voluntary provisions also where you can have this, you can now convert your private limited company into OPC by passing a special resolution, NOC from members and creditors in writing, and then you file the application with the ROC with the necessary documentation as prescribed under the rules. Now, this is the much debated topic, perhaps going to be much debated topic as far as this particular presentation is concerned. Yesterday, we have received certain queries also as, regarding this deposit. Let me say this thing that this particular chapter, I believe this is chapter 5, cannot be completed in just a 15 minutes time. It requires a whole day session if we want to analyze in detail. So I'm just running through few of the things which might impact you immediately. Let us start with the relevant provisions. That is the section 2, clause 31, section 73 to 76, and the company's acceptance of deposit rules 2014. Now it defines the deposit. It's a very interesting definition given that the deposit includes. First, it's an inclusive definition, not an exhaustive kind of a definition. It's an inclusive definition that it includes any receipt of money by way of deposit or loan or any other form by a company, but does not include such categories as may be prescribed. So government has already notified this company's acceptance of deposit rules 2014, where they have given the deposit definition against and what are the categories which are to be excluded. So they have already defined in that particular definition. So a detailed definition is prescribed under the rules. Now I'm not going into the details of that particular definition. Some of the things which might be related to you, that what should not be included in the definition of deposit. So number one item, that any amount received by a company by another company. So it is not required to be, it will not be treated as deposit. So you may not be worried about this particular aspect. The second one is the share application money. Now this is something which is for the first time we have seen in the Act, where the indirectly Act has given the time limit for the allotment of the shares. We have never seen before that where people used to receive the share application money. It is lying in the balance sheet for years, and no shares is allotted. Now in the deposit definition, they have specifically said that share application money is not included in the deposit. However, if shares are not allotted within a period of 60 days time, then it will be treated as deposit. So you have, once the 60 days time limit is over, you have to refund that particular share application money lying with you to the person from whom you have received it. and within next 15 days. So from 75th day, it has to be out of your company. That money is out of your company. And the provision also says that this application money cannot be adjusted against any kind of amount, any other amount. So you have to actually refund this amount. You cannot adjust any other debts of that particular person from you have received this amount. So this is one of the provision which has already been in force from last 15 days. So you need to take care of this particular aspect. So if you have any kind of share application money lying with you, so please handle it carefully. Next point which might impact you, that any amount received from a company, from a person who at the time of receipt of the money was a director of the company. So now in earlier act we have seen the private limited company definition, which is the clause 4 of that particular definition was saying that you can receive, the private limited company can receive a deposit from the director's member or their relatives. So that particular clause is now deleted from the definition. And in the deposit definition, they have not included the amount received from the directors. So indirectly, whatever amount you have received from the shareholders or their relatives, it will be treated as deposit as far as this particular act is concerned. And even for the directors, they have specifically mentioned that before receiving this money, you have to take a declaration from the director that this money is not borrowed by that particular director. It's his own fund which he has given to the company. Next is amount received from the employee. So you are receiving any kind of deposit from the employee more than what is his annual salary. So it will be treated as deposit up to. So any amount received from the employee is not a deposit, but if it is crossing more than his salary, it will be treated as deposit. As far as annual salary, it will be treated as deposit as far as this act is concerned. And the amount received in the course of business. Now, this is a much disputed topic. What should be because the section also, this rule also says any amount, if you have received any amount as an advance you have received for the goods or for the services, and if it is, and you have not able to deliver that goods or services within a period of 365 days. So from the 366th day, it will be treated as deposit. Now, I'm sure this particular topic is going to be debated in detail. Of course, we are also doing some internal analysis of this particular rule, what is to be done, because in the broker, I believe there is a circular dated 3rd December 2009, which is dealing between the stockbroker and the client, where the running account authorization you need to take on a monthly basis and the quarterly basis, and it has to be, the account required to be settled on a monthly basis or the quarterly basis as per the choice of the investor. Since though it's a BSE, but still I can say that the many of the broker who are not able to comply that particular provision due to their own reasons. So if you are holding this particular amount, it might be treated as deposit if it is beyond 365 days. I've said might be because I've already tell that we are doing some internal analysis of this particular aspect, whether it should be the part of deposit or not. So now we have another pressure as far as broker community is concerned. We have another pressure from the regulator for the settling of the accounts. Now there will be a contradiction between the SEBI and the Companies Act, because SEBI circular also allows to retain certain amount of funds. The last day trade in the cash market segment, and I think 225% of your margin exposure, so that you can retain. And recently they have come out with some small amount if you are still having in your, so you need not to settle those kind of accounts. Especially in the commodity side, the FMC has also said that up to 10,000 rupees you need not to settle the accounts. So what will happen to those particular deposits if it is lying in the client's account? So that needs to be analyzed. Now there is another provision which says that there is a form prescribed called DPT-4. So you need to file within within 3 months time from the implementation of this particular act. So you have to file by 30th of June. Now this provision is be filed by each and every company, whether it is private, whether it is public, or whatever kind of category you are. You have to file this particular form within a period of 3 months from the commencement of this act. That means up to 30th of June 2014. With ROC giving the details of all unpaid and also the all details of amount unpaid, and also the and you need to repay that particular amount within a period of 1 year. So as I said, for example, you have some amount you have obtained from the shareholder as a private limited company, and so it has become the deposit with effect from 1st of April. Because of the new definition. So by 30th of June, you need to disclose it to the ROC that I have this particular amount lying with me, which is falling in the definition of deposit, and within a period of 1 year, you have to refund that particular amount to that particular person. So you have to, structure your finances accordingly, as far as this particular provision is concerned. And the DPT-4 form, it looks very small form, but as far as its attachment is concerned, it's asking for so many different information. So you need to disclose the name and addresses and all other details of each and every individual and amount and whatever is prescribed there. So it's a look like a small form, but actually in practically it is going to be a very big exercise. These rules are applicable to private companies also. So you need whatever the exemption available to the private company is now gone, and the penalty is something crazy as far as this chapter is concerned. So minimum 1 crore penalty, as Mr. Mehta already said that. And they have the concept of minimum penalty. So even this penalty cannot be reduced. So 1 crore is the minimum amount of penalty if you have made a default of any small amount also. And maximum it can be increased to 10 crore of rupees, and officer in default 7 years imprisonment and fine, which is 25 lakh of rupees to the minimum, and maximum 2 crore to officer in default. So penalty is of course very crazy as far as this section is concerned. So you need to handle this particular aspect, and you don't have time also. You have to analyze maybe from tomorrow itself, if you have not done it, what kind of amount is falling in the deposit, and you need to work out as far as filing of this particular DPT-4 is concerned. Now, let me come to the director's disqualification. This section is much similar to what was there earlier in earlier act, that is section 274. However, this particular section 164 subsection 1 and 2, the first subsection is more or less similar. There is no big change as far as first part is concerned. Whatever you are seeing on your screen, it is not changed except the last part, that the DIN is now made it mandatory before the appointment itself. So that is added in this particular subsection 1. Now this is subsection 2, which is talking about the non-filing of annual return or annual accounts for a continuous period of 3 years. So this particular provision, which was there under section 274 1G of the 1956 Act, that was talking about only public company. So now this section is also applicable to private company. Now another problem with this particular section is that the director, once becoming disqualified in this particular section, they cannot be eligible to be appointed in any company for a period of 5 years. So if any of your director is a director of a company which as on 31st of March has not filed its annual accounts or annual return with the registrar, so he has already become disqualified with effect from 1st of April. And he has become disqualified, so he cannot be appointed as director in any of the company for a period of 5 years. So this is the intention behind putting this particular section in this presentation. Because there are many companies, sometimes it happens in groups, normally we have not filed the accounts or something like that. So this you need to take care. I don't know how you are going to take care of this particular aspect, but of course the provision is there, so we have to comply with this. Not only this, There is another section called vacation of office. This was also there in the earlier act, but this section is also the first point. If you can see that if he incurs any of the disqualification specified in 164, so whatever we have seen in disqualification. So if you have incurred any kind of disqualification in 164, your office becomes immediately vacated. So these are the serious impact on the directorship. And if it is vacated because of non-filing of annual return and all those things and non-payment of dividends and all, then 5 years disqualification is there. The another provision in vacation of office regarding that he absents himself, means a director if absents himself for all the meetings of the board of directors held during a period of 12 months with or without seeking the leave of absence. So this is another provision where there are directors who never attends any board meetings of the company, and we used to grant them leave of absence. So if during a period of 12 months, if they have not attended any meeting, so whether you grant them leave of absence or you don't grant leave of absence, they will become automatically, they have to vacate their office as a director. The rest of the provision are more or less similar what was there under the old act. Now this is another provision, resignation. Why I have put this particular provision here? Because there is a change in the procedure of, first of all, this provision is first time introduced in the act where the directors are not required. In earlier act there was nothing in the law as such about the resignation of directors. So we were dealing the resignation most because of the judicial precedents or maybe the traditional or customary on the customary side, but this time they have put the specific provision in as far as resignation of director is concerned. So director has to give notice to the company in writing, and they have to file a form DIR 12 to the ROC. Now, this is the responsibility of director that if he is resigning from the directorship of a company, so he has to file, apart from giving notice to the company in writing, he has to file DIR 12 form to the registrar. Means it's a personal responsibility of director to file this particular form, because we have seen a lot of incidents where the directors has resigned but the company has not intimated to the registrar, and their liabilities because of judicial precedents continues till the time the intimation is not given to the registrar. So now this time the government has decided to give this particular responsibility to the director itself, that if you are resigning, you intimate to the registrar in this particular form. Apart from this, company is also responsible, but as far as director per se is concerned, they have to intimate to the registrar. Now these are certain, this is the section 180, which was actually notified last year September itself, which is giving the certain powers, restricting certain powers of the board of directors. Now section 80 is the corresponding section of 292 of the old act, but that section was applicable only on public company, but this particular section is applicable on private companies also. So as far as what I understand, broking community, I believe the subsection 1 clause C, which is power to borrow money exceeding the limits prescribed in the act. So for that particular, normally private limited company, they just make some arrangement with the banks and borrow the money. So now they have to also take the permission from the members of the company by way of a special resolution. Even in the earlier act, the section was applicable only to public company, but that by way of ordinary resolution only. But this time, it is applicable to private companies also, and by way of a special resolution. And the government has issued a circular 4/2014, sorry. So they have given a 1-year transition period as far as, but this transition period is for those companies who have earlier passed the ordinary resolution for giving power to the borrowing power to the company. So now they have to do the special resolution. So they have given 1-year time, transition period, to continue with the ordinary resolution, but after 1 year from the original implementation date of this section, that is 12th of September 2013. So by that date, you need to pass a special resolution for exercising borrowing powers. But this particular 1 year transition period is not available to the private limited companies, because the circular is very specifically saying that 1 year transition period is for those companies who have earlier passed the ordinary resolution. So any private limited company wants to exercise borrowing power, they have to have this resolution passed before borrowing if crossing the limit. Now, this is another section which is much talked about. The section heading, if you will say, so you will find what is in this section, that is calling the loan, that is talking about loans to directors. But the word put etc. also. So this section deals with lot many other things apart from loans to directors. Now, this section is saying that the no company shall directly or indirectly. So any kind of loan advance, you cannot, any company cannot advance any kind of loan, whether it may be represented in form of book debts, to any of its director or any other person in whom the director is interested. Now, this particular definition is, this particular explanation is given in the Act. What does it mean, in whom the director is interested? So we'll come to that. So first of all, any company, whether public company, whether private company, they cannot give loan to its directors or any other person in whom the director is interested. Therefore, that etc. is put in this particular section heading. They cannot give also the guarantee or provide any security in connection with any loan taken by him or such other person. So if a director have taken a loan, or that other person in which he is interested, those persons have taken a loan, and guarantee and security of that particular loan is provided by the company, so that cannot be done as far as this 185 section is concerned. Now, is it visible? I don't know. Now, if you see what is defined in the any other person in whom director is interested, so these are the 4 or 5 categories is given, like the company, firm, private company, body corporate. So all these are the entities where you cannot give the loan, cannot provide any guarantee, or cannot give any security in connection with a loan. So company means what? The director of the lending company, with the company which is giving the loan. So you cannot give the loan to the director, of course. Director of its holding company. So if you have the commodity entity which is giving any loan to the directors, and normally the commodity entity is the subsidiary of your equity entity. So you cannot, even that equity entity will also form part of this. Any of the director of that equity entity cannot take the loan or guarantee or security. Any partner, such directors, so those cannot have. Then the relative of any such directors. So this is the wide, as far as this directors are concerned. Now the firm where the director or such director is a partner, or any firm in which they are the partner, and any firm in which any of the relative of such director is a partner. So even the relative is also a partner. Now relative definition is also defined in the Act. So, and the private company in which any such director is a director, or any private companies of which such director is a member. So those private companies also the part of this loan. And the body corporate where the such director can exercise more, or their relative can exercise more than 2% of the voting power put together. Or any body corporate where the board of directors is accustomed to act according to instruction and direction. So this is a wide term. So you need to take care as far as this particular section is concerned. Now, the difference between the old Act and this new Act, that earlier you can do this type of transaction by obtaining the central government approval. However, now this approval route is also gone. So this is a completely prohibited provision. So you cannot go ahead with this kind of transaction at all. There are certain exception is given. So loans to managing director or whole-time director you can give, provided it's a part of service condition extended to all the employees, because they are the normally they are in the whole-time employment of the company. So if any part of service is talking about which is extended to all the employees, so you can give, and pursuant to any scheme approved by the members by way of a special resolution. So this is only limited to whole-time director or managing director, and any company in which ordinary course of business provide loans, guarantee security, and the interest in respect of such loan is not less than the bank rate charged by the RBI. Now, this now the point 3 onwards prescribed under the rules that any loan made by any holding company to its wholly owned subsidiary. Now the word is used is wholly owned. Subsidiary company or any guarantee given or security provided by holding company in respect of any loan made to its wholly owned subsidiary company is exempted from the requirement of this section. So any company can give loan to its wholly owned subsidiary. If it's a subsidiary, you cannot, but if it's a wholly owned, you can, right? Guarantee and security provided by holding company in respect of any loan made by any bank or financial institution to subsidiary. Now, if a subsidiary is taking any loan from the financial institution or bank, then the guarantee and security in connection with that particular loan can be given by the holding company. But in both the condition, the loan utilization, the fund utilization has to be for the principal business activity of that particular company. So you have to demonstrate in case of any inspection or in case of any regulatory action, you have to demonstrate that this particular fund is utilized for the principal business activity of that company only. Again, the penalty is prescribed to the company is 5 lakhs to 25 lakhs, imprisonment 6 months, to directors rupees 5 lakhs or 25 lakhs or both. So these are the penalty prescribed under this particular section. Now this is another section which is talking about loans and investment by the company. This is section 186. Now what was the difference between 185 and 186? That was specific to directors. So whatever is prohibited in that particular section, you cannot take the shelter of this particular section. So it is corresponding to the 372A of the old act, however, with some of the major changes. As I said, once the loans to the directors section is applicable to your company, then you cannot come to the 186. That transaction at all cannot be entered into at all. Now, this section is talking about that no company shall directly or indirectly give any loan to any person. Now, the word uses any person. Earlier, this section was dealing with inter-corporate loans, but now they are talking about any person or any other body corporate. Give any guarantee or provide or security in connection with a loan to any other body corporate or any person. So again, the word uses person. Or acquire by way of subscription, purchase, or otherwise the securities of any other body corporate. This section is similar. So the limit is prescribed. The limit is again similar, except they have added the securities premium account. So exceeding 60% of paid up share capital, free reserves and securities premium account, or 100% of free reserve and securities premium account, whichever is higher. So you have to structure now your loan activity. Normally, again, it happens that you might be giving loans to somebody. So that will be now the covering in the part of the 60% or 100%, unlike in the earlier act, because earlier act was talking about only inter-corporate loans. But this section is talking about loans and the guarantee and security to any person. So the scope of this particular section is much wider than the previous one. Now, if you want to go beyond this particular limit, then what will happen? You have to take the prior approval by way of a special resolution. One clarification is given in the rules that the special resolution may be passed within a period of 1 year from the date of commencement. So this relaxation is given that till up to 1 year, they have some kind of relaxation that you can pass the special resolution till till the period of 1 year. And resolution cannot be a blanket resolution. You have to prescribe some kind of limit to the up to which extent the loans and guarantee or securities may be provided. A special resolution is not required in case of loan guarantee given or where the security has been provided by a company to its wholly owned subsidiary, again wholly owned, joint venture company, or if acquisition is made by holding company by way of subscription, purchase, or otherwise in the securities of its wholly owned subsidiary. And but the company has to disclose all these transactions in their financial statement. Now, if within the limit, now if you want to, this was what we have discussed. If you're crossing the limit, then you have to go for the special resolution. But if it is within the limit, then you need to take the permission of the board. That has to be a unanimous resolution. Now, if any board member says no to that transaction, you cannot have that particular transaction. It has to be a unanimous resolution at the meeting of the board. So you cannot have circular resolution. You have to pass the resolution at the meeting of the board. And if your loan is subsisting with any of the financial institution or bank, and if you have made any kind of default in any installment, so you need to take the prior approval of that financial institution or bank also. Now, section 186, subsection 6 is related to market intermediaries. Because this section says that no company registered under section 12 of SEBI Act. Now, section 12 of SEBI Act is talking about the registration of market intermediary, like which covers the stockbroker and sub-brokers also, and also covered such classes of company as may be notified in consultation with SEBI. They cannot take any intercorporate loans or deposit in excess of the limit specified under the regulation applicable to such company pursuant to which the license, whatever the certificate of registration is granted by the SEBI. So if SEBI prescribes some kind of limit to you that you cannot go beyond this particular limit, or any of the regulations prescribed by SEBI says that, that the broker cannot go beyond this particular limit, so you have to follow that particular limit. So this is the specific provision as far as market intermediaries are concerned. Next, loan, there are some interest, what should be the minimum rate of interest you need to charge, it is prescribed. And next provision is another interesting one, that if the company has defaulted in repayment of any deposit accepted or interest before and after the commencement of this act, it shall not give any loan guarantee or security or make any acquisition till default continues. So whatever we have seen in the deposit related chapter, if you have any kind of default in that particular section, so you cannot go for giving guarantee or security or loans or whatever in this particular section also. And there is a register format is prescribed, so you need to maintain a register with the particulars whatever is prescribed under the rules. Now there are certain exceptions are given in this section, but those are available to banking companies, insurance companies, housing finance companies in their ordinary course of business, or any acquisition made by NBFC or investment companies where the principal business is acquisition of securities. So these are the exceptions given in this section. Penalty is again 25,000 to 5 lakhs, officer in default imprisonment 2 years, and fine of rupees 25,000 to rupees 1 lakh. Now this is another new provision in the act itself. Many of you must have followed this particular provision in accounting standard, but these are some specific provisions prescribed under the law related to relating to the related party transactions. So now the related party is defined under section 2, the clause 76 of the act, that it defines as the related party in relation to any company means a director or his relative, key managerial personnel or his relative. There is a separate definition of key managerial personnel is given, which includes whole-time director, CFO, company secretary. So not only those KMPs, but their relatives. Firm in which director's manager or his relative is a partner, private company in which director manager is a member or director, public company in which director or manager is a director or holds along with his relative more than 2% of paid up share capital, and any body corporate according to whose instruction we are accustomed to act, and any other person whose advice except in the professional nature, if the advice is some of professional nature, that cannot be the part of related party, otherwise all will be treated as a related party. Now any company which is a holding, any company which is a holding subsidiary or associate company of such particular company, that will also be treated as your related party, and subsidiary of holding company to which I'm not able to see this properly. Anyway, and there are certain, after that, there are certain rules making power is given, also given, that such class of company as may be prescribed. So in the rules, they have prescribed that the director or the key managerial person of the holding company or their relative will also be treated as a related party. So there is a wide definition of related party is given. Now, if you see, what you cannot do with your related party. So board approval shall required at the board meeting for entering into the following contract or arrangements with the related parties. So your board has to if you are going for any of this particular transaction, sale, purchase or supply of any goods, material, selling or otherwise disposing of uh, or buying of any property of any kind, leasing of any property of any kind, availing and rendering of services. Now see the impact on this particular aspect was there also in 1956 Act, where if any of your director wants to open the trading account with the broker, so you need to have the central government approval or the in under that section 297. So here that now you can do with the board resolution itself. And the appointment of any agent for the purchase or sale or supply, sale or goods or material or services or property, such related parties appointment in the office or place of profit, and underwriting contract. So this contract, if you are entering with any of your related, so you need to have the board approval. Now, aforesaid contract, whatever we have seen, this A to G, so this cannot be done. This can be done by way of special resolution if following conditions are satisfied. So first is in the normal circumstances, you can enter in the transaction with your related party by way of board resolution. But if these conditions are satisfied, then you have to go to the members for permission by way of special resolution. So first is where the paid up capital of the company is 10 crore or more. So all the transactions, you need to get it approved by the members by way of special resolution. Now, in my list, these are the transactions specified A, B, C, D, E, F, G. So for A to E, if value of transaction exceed 25 of the percent of the annual turnover, then you have to go for the special resolution. So these are the categorization given for which transaction you need to go for the special resolution. Turnover, net worth shall be on the basis of audited financial statement in the preceding financial year. Now the separate definition of net worth and turnover is given under the definition part of the new act. Member should, now this is another provision, very stringent provision, that member should not vote on any special resolution if such member is the related party. So if any of the directors holding the shares and you are falling in the category of related party, so that director is not entitled to vote in that particular meeting because he is also the shareholder, so he is right to vote. So he cannot vote in that particular special resolution because of this restriction put by the act. There are certain provisions that what if it is entered by director or any other employee without requisite approval, so it is voidable at the option of the company, and company may ask may go for the prosecution against such directors. Interested directors shall not be present at the meeting during the discussion. So this is another provision. They cannot be the part of that particular meeting itself. Now, exemption is given that any transaction entered by the company in the ordinary course of business on an arm's length basis. Now, this is again a very much debated issue, what should be treated as arm's length basis or not. So without going to the discussion on that, what should be the arm's length and what should not be the arm's length, probably the broker who are having the NBFC, so they must know what is the arm's length and what is not the arm's length, where the RBI also specified that your server should be separated and all those things should be separated, so that kind of arm's length they have prescribed. So if you can maintain that kind of, so it is allowed, but it's now there are, this is the last slide of the presentation. There are certain points which specifically I have mentioned, which I have not prepared the detailed slide of that. Now I'll just go through quickly. That the power to adjudicate penalty. Now this time, earlier whenever ROC wants to prosecute any company, they need to go to the court for obtaining the permission of the court, but now the ROC itself can prosecute to the company, just like SEBI. So they will act as an adjudicating officers, and the appeal against the order of the ROC can be made to the RD. So for that, rules has already been notified. Compounding of offenses, it is another section which is yet to be notified, but however the difference is that In earlier law, wherever the fine or imprisonment is there, then it can be compounded. But now in this act, only fine, where the only fine is prescribed, that offense can be compounded, rest of the offenses cannot be compounded. Board report is already covered, so I'm not going into the detail. It's a big document which you need to prepare. However, government has given the relaxation for the financial year 13-14. So you can prepare your board reports according to old law. From next year, from this financial year onwards, you have to prepare in the new law. Secretarial standards is also made it mandatory under these two sections. Then Serious Fraud Investigation Office is given the tremendous power in this act. The body is already there, but now it's become the part of legislation itself. And this authority has given the huge amount of powers as far as enforcement is concerned. Then the separate section related to fraud has been defined in this act, and for the fraud there is a imprisonment prescribed for the 10 years. Maybe the cases like NSCL may be covered in that. But the fraud definition is much wider what is prescribed in the Criminal Procedure Code. So the definition of fraud under Companies Act is much wider than this. So these are some of the specific points which you might keep into mind while dealing with any of the transactions. With this, I conclude this presentation. Thank you for your patience hearing.
Thank you very much, Mr. Anshul. We can have a couple of one or two questions if any audience wants to ask any question.
See, as I said, in my presentations, running a private limited company is like unless and until you have a big plans and you can afford to have those compliance costs. That is what we are expecting. Many company A will close down. B, either they will go to the. Of course, if it is not that operating company, you can just go to the ROC and make an application for a dormant company. So you'll have a very less compliance. Or otherwise, as you rightly said, LLP, there is no provision in the rules at the moment, for, it says, you can convert a private limited company and to OPC, but there is nothing like no provision for the LLP. So probably we are just waiting for it.
Hello. As far as OPC is concerned, I forget to mention one particular point that the recognition by SEBI to OPC is yet to be given. Like SEBI has given recognition to LLP in their regulation maybe after 1.5 year time after implementation of LLP Act. So we have to wait and see whether SEBI is permitting to convert your entity into OPC or not.
I have a query related to, regarding the related party transaction. Now, if there are two directors in the board and both are brothers, and one of the director, he's transacted with his brother-in-law.
Sorry,
There are two directors on the board.
Right.
And both of them are brothers, real brothers. Now, one of the director, he's transacted with another person who is a brother-in-law, who is his brother-in-law. So the second director, will it be a related party transaction?
Even to the best of my remembrance, even the second director, who is actually the brother-in-law, is not treated as the related party because brother-in-law is now out of the purview of definition of relative.
Okay. And second, about this, the deposit, considering that, after 30th June, you have to file it as deposit any creditors, and you have to repay them within a year. Now, I take this example of NSCL. Now, it has defaulted. Now, the clients, there's a, there are creditors. So, obviously, the money, we don't know when it is going to come. How will you treat that?
They are already created such a mess in the system, and they are already done a lot of, they are already in such a huge default. One more default is not going to harm anything to them. So,
no, but what the brokers
technically,
do?
yes, they have to pay it. No option as far as this act is concerned.
So you have to declare them as depositors.
Yes. Yes, if it is pending for more than 365 days, so I believe this 365 days. I think this NSCL entire episode came into limelight on 31st of July last year. So, so since then there is no transaction on the exchange. So this amount is just lying with the exchange itself. So within a period of 365 days from 1st of April onwards, they have to repay this amount. So probably it might give a hope to you that from up to 31st of March 2015, you might recover entire money, which highly unlikely, but it might happen.
No, but if they don't pay,
So
then it's a violation, the penalty of 1
it's a
crore.
violation, right?
Thank you.
Atul, on many places we see, the trigger point is turnover.
Yeah.
What is the turnover for broking entity in this case?
I think it cannot be the total, the thing, it has to be a brokerage, like the amount, which you earned as a brokerage, that should be taken as a turnover. Sorry? Acha, margin money, okay.
Margin money more than a year, and you are not utilizing that money for the transaction of the client. See, my understanding says if you are utilizing the funds of the client and then keeping with you and utilizing also, client is trading and his money is increasing, decreasing, and there are some movements. So probably that stand can be taken that it is not an advance. Now you are not doing anything with the money and keeping with you as a margin, which of course SEBI is not allowing as per that December 3rd circular, but then it will become a violation in my view.
No, but there are two. One is security deposit and one is a margin deposit. Security deposit remains with the broker for a long period. And margin, margin in the running account we settle on a quarterly basis.
That's what I've said, that we are still in the process of analyzing what should be because it's a complex structure as far as broking is concerned. You take the margin, you somewhat you take the bank guarantees, or you take the lien on FDs. So all those things, and lien on FDs and all those things are not required to be settled as per the SEBI circular. So if you are keeping those kind of FDs and funds, so what will happen to those? So it requires some amount of time and research. So we are doing it.
If, excuse me?
I think there are certain exempted categories of deposits, which are not been said as a, like, if I'm taking any kind of advance, for some kind of a business, for my day-to-day business, it will not be treated as a deposits. There are certain categories of deposit which is exempted categories.
Hello. If a director is also a shareholder and he has given loan to the broking company, then it will fall under the definition of deposits? If a director is also a shareholder in the broking company and he has given loan to the broking company, then will it fall under the definition of deposits?
No, if he is a director, then he can give, provided he has to give a declaration that he has given the money to the company out of his own funds and it's not a borrowed
But he is
fund.
also a shareholder.
That's fine.
That's fine.
It's a borrowed fund, then it will be treated as deposit. Very specific provision given in the rules.
Hello.
If he doesn't give the declaration, or if he gives the declaration that it is out of the borrowed fund, then it will be treated as deposit.
Sir, my question is regarding the acceptance of deposit. Suppose one company is accepted deposit from another company, it is exempted.
Right.
Then in this case also required to file a DT.
DPT4 form is required to be filed with, by 30th of June for the whatever deposit you have. Now this is not falling in the definition of deposit, but it is exclusively not included in the definition of deposit. Therefore, to my view, it is not required to be disclosed.
And one question from a related party transaction. The remuneration exists 2.5 lakhs. This is include, suppose 3 directors in a company and we give 1 lakh to each director.
No, it's one individual wise you have to see that it cannot be clubbed. You have to see individual wise.
Okay, thank you.
Thank you, everyone. Thank you, the speakers, for giving us such a valuable insight. Just last 1 minute. I would request Shri Siddharth sir, our chairman, to give memento on behalf of BSE Brokers Forum to the honorable speakers.
Thank you.